Hello and welcome back. This is episode 2 of Sitting Down at the Charts. The idea is that you can understand exactly what I'm thinking at every stage while I'm sitting down at the charts and why I'm doing what I'm doing. I'll not waffle anymore. What I want to do straight away is get onto TradingView. So I've hopped onto TradingView.com. Now the first thing I want to do is get some indicators. So I only use 2 indicators, but these are really good. First one is PA Toolkit Lite, and the second one is buy side and sell side liquidity. All that these indicators are showing me is, as I've said, buy side and sell side liquidity, change of characters and break of structures within the market. This isn't a necessity, and if you want to do this on your own, you're more than welcome to. This is just easier to see. So as you can see, it'll show you the change of characters, the break of structures, show you some buy side liquidity, all that good stuff. The areas down the bottom are order blocks or areas of support. So when price revisits these zones, as it has done here, we can expect that we might get another reaction. The other areas that I've got marked out, for example this area in the blue here, are just different bits and bobs I want to talk about throughout the video. So what I'm going to do from my top down analysis is mark out any areas of liquidity that haven't already been fulfilled. Also we've got stuff like breaks of structure on fair value gaps, so something like this. I would imagine price might get a reaction from this level, albeit quite small. Different areas like this, so when we move on to the lower time frames, entry time frames, you can then see when price enters this zone, we're looking for a reversal or we're looking to use this as a confluence to take an entry. If you aren't using these indicators, what I would suggest you do is just look for order blocks, fair value gaps and old highs and lows. Then you want to jump down to your entry time frame, so this might be 5 minutes or 1 minute depending on the way you trade. I really like the 5 minute. The reason I use the 5 minute over the 1 minute is I feel like the 1 minute can move a little bit too fast, can be a little bit more difficult to get entries in, so we're just going to stick to the 5 minute. One thing I will highlight is news. News is not something that I trade, it's not something that anyone in our group trades as well. On the TradingView dashboard, you can see is you actually get notifications depending on what currency pair you're trading. So for example, we're trading gold USD. We can see here that at the 17th of December at 8:30, we've got red fuller news. This just means that the market is very likely to react quite significantly at these areas. So you generally don't want to have a trade on during these times. So one thing that I'll try and reiterate to everyone in the group is that we need to stack confluences. We don't just want one thing telling us the market's going to move one way, we want as many things as possible so that we get the highest probability trade. For example, what I'm going to talk about in a minute is inverted fair value gap. Now, this is on the gold and the 5 minute time frame. As you can see, we get a fair value gap here and we get an inverted fair value gap as the bearish candle has just closed below this fair value gap. This is a perfect inverted fair value gap setup. However, I don't want to take just that. I don't want to have only that confluence. What I also want is something else telling us that the market's going to react from this zone. So luckily, this inverted fair value gap has formed at this level. So as you can see, we've got on the 1 hour time frame, we've got an order block and it's actually swept the liquidity, which is absolutely brilliant. A liquidity sweep generally means that the market's going to move in the opposite way. It stops out all the sellers in the market and then goes in the bearish direction, which is brilliant for us. You can see they've got a really small fair value gap shown by the slither. It gets disrespected, so we now go short from this area. We only want to take an entry when this candle is closed, because we don't want the price to just wick through the fair value gap. We need it, in the bearish example, close below it. It then comes the issue of where do you place your take profit and where do you take your stop loss. So the stop loss, I would always put at the high. And for this example, I would always put, for a bearish inverted fair value gap, always put at the high. The take profit is a bit more subjective. Reason being, you can place the take profit at any area of liquidity. I don't have a set RR, I don't have for example a 2 RR. I kind of play by ear in the sense that I know that price is going to move to some level of liquidity, as price is always moving towards some sort of liquidity. It's up to us, up to yourself, to decide how strong of a trade that you think it is, to what level you think it's going to go. So, for example, I could just choose, this one here, this low right here. Or, what I could do is choose this order block down here. Or, I could just go for this fair value gap right here. So I think we're going to get a pretty significant reaction to this price. So I would either go for this fair value gap here, as it's not been fulfilled yet, or there's an order block right here as well. I'll just put it at that fair value gap. This gives us a 2.73 RR trade, which is absolutely brilliant, very good. The reason this worked is because we correctly identified the inverted fair value gap, happy days. And this inverted fair value gap occurred after a liquidity sweep. So price had swept out all of the sellers in the market and then completed its market reversal, making us happy traders. The next example I'm going to look at is something that's very simple and very common in the market. It's as simple as a breakup structure and a fair value gap. This kind of links in quite nicely to support and resistance. I don't trade support and resistance, but it's a similar sort of concept. So in the next example, we're on the 15-minute time frame. As you can see, we've broke the structure. I've not got the indicator on for this example just so we can see it clearly ourselves. Had a nice breakup structure here. So what we're going to also notice is that there's a fair value gap that's been formed on this breakup structure. So we know that when price comes back and revisits this zone, it's very likely that we're going to be able to get an entry. So if I just zoom forward a little bit, price hasn't touched quite yet. Okay, perfect. So price has dipped into this zone, so we've now taken an entry. So now we have the luxury of choosing where to put our stop loss and take profit. I would just high my stop loss at this swing low here. And then what I would also do is, well, we've got the luxury of choosing at which point of liquidity up this zone do we want to put our TP at. So we've got a fair value gap here, we've got a fair value gap here, we've got order block up here. But this, because we're trading on the 50-minute time frame, this is a a pretty significantly large trade. So I could have it at this fair value up here, and I'd still be winning 145 pips, which is it's very good. It's a nice amount of pips to win by, and it's a 1.5 RR trade, so it's happy days. So we would take an entry from here, brilliant. What I would also do is, when we go into significant profit, so now we're in significant profit, right? We're now 60 pips or 50 pips in the green. I would move my stop loss to break even. As is to everyone in VIP, there's no point in forcing a win. If a trade hasn't reacted the way you want it to react, or hasn't hit your TP just yet, put your stop loss to a little bit of profit, or put your stop loss to break even, and you're not going to lose. So we end up hitting take profit nicely here. That was a nice 145 pips. I've just zoomed ahead in time again, and I've seen a very similar setup. We've got another breakup structure. If you look from this zone and you go out, you can see that there's a fair value gap that's formed on this level. So what I would have done is, when price hit this zone again, I would have had my stop loss at this low, and then me TP at another area of liquidity. So whether it would have been, well, another 1.5 would have took us to that area, we would have hit TP, or we could have been a bit greedy and went for this order block right here. Either way, you would have been in 140 pips profit again. So this just shows it works consistently. If you can spot a fair value gap and a breakup structure, putting them together, and it's even better if there's a, inverted fair value gap or something like that as well, to put on even another confluence and make that trade that much more high probability to win. The third entry model that I tend to use is the unicorn model. Everyone in the group will know exactly what I'm talking about, because I harp on and on about this. But the reason I do it is because it works so consistently. In the unicorn model, all you're looking for is 2 breakup structures and then an order block and a fair value gap within these breakup structures. So you can see here, we've got one breakup structure. You can see here, we've got a second breakup structure. And then within these zones, what we're expecting to see is, at this point, before this big bearish push, we're expecting an order block here. And what we'll want to see is a fair value gap formed on this bullish move. So let's say there's a fair value gap here as well. The areas where these overlap is called the unicorn zone. So you can see just there, what we'd do is take an entry from this zone, put that at the low, and then put that at some area of liquidity. That is, in simplest terms, what we're looking for, and it's just the opposite in the other direction. So yeah, you still want 2 breakup structures in the bearish example, you're just looking for the opposite. And we actually have a bearish example right now. So as you can see here, on the 5-minute time frame, we've got a green zone at the top. Now this is simply an area of resistance. So price keeps hitting this zone, but it's not able to break through. It keeps reacting from this zone. So this zone might be seen as a premium by sellers in the market. What we can see, I've got the first breakup structure, nicely. Second breakup structure here. We've got an order block as marked out in the pink. And then in the purple, what we've got is a big bearish fair value gap. The area where these two overlap is called the unicorn zone. So in the simplest terms, all we'll do is take an entry from that point. If you want to play it very safe, put it at the high or the low, depending on what you're looking at. If you're feeling a bit risky, just put that just below the bottom of the zone. And now, what we're looking for is a significant reaction, and I think we're going to get one. Reason being, Not just have we hit a resistance zone, we've also got a breaker block and a fair value gap. So now we've got three things telling us that the market's going to be bearish. So I'll put it this low and I'll expect to blow it out the water. After some deliberation, what we'd get is a nice win. Price wicked back into the fair value gap, had another little taste again, and then had a more significant bearish reaction, and we hit TP 1.9 RR trade, which is absolutely brilliant. One key piece of information that I want to tell all of you, that I tell every single person in the VIP, is that what you need to do in this scenario, don't look for the fair value gaps in the breaker blocks. What you need to look for is the breakup structures. The fair value gap and the order blocks will be within that zone. So don't look for these areas, just look for the breakup structures and the rest will come. If you're looking for education, free signals, join our community where I've got hundreds and hundreds of members all learning together to be profitable traders. By all means, go into my bio, click the link and join the Telegram. Something I've mentioned quite a lot during this video is liquidity. And the reason I say it quite a lot is it's basically the whole basis of my strategy. We know that price is always moving towards some sort of liquidity. So price might be trying to sweep the liquidity of an old high, or price might be seeking the liquidity in a fair value gap. Point being, we use this to enter trades and to know where to put our take profit and stop loss. So to go back to this example, when we've took an entry here, the reason we put our stop loss just above this zone is that we know that price may well want to seek the liquidity left at this fair value gap, which it has. You can see price went all but 6 pips away from hitting stop loss, but that's not by chance, that's not by luck. We know that price is very likely to want to seek the liquidity from that fair value gap, as it has. Equivalently, for putting the take profit, we know that because we've got 3 confluences telling us that the market is bearish, the chances are price wants to sweep that old low, and price may well want to sweep this old low as well. I mean, if we go ahead and have a look, it sweeps that old low as well. You could have had a ridiculous 1.26 RR trade in that, all because you know that price is moving towards some sort of liquidity or sweeping some sort of liquidity. And as we can see here, after price has swept the liquidity of the low, it's now in the opposite direction. And then we get a reaction from this fair value gap, another area of liquidity. Price is always just bouncing between these areas of liquidity. We just spoke about the stop loss. This is kind of like finding a sweet spot. I will always recommend everyone uses the lot size calculator. I've said time and time again. The reason I say is because it's so important to not over leverage your account and to make consistent profit. So the smaller the size of your stop loss, the higher lot size you're going to use, because you're risking a percentage of your account. And so if the stop loss is smaller, you're going to lose by less pips, and therefore you can afford to have a bigger lot size. This might tempt you to decrease your size of your stop loss, but that's not really what you want to do. What you want to do is find the sweet spot. What you want to do is also minimize any risk of significant loss. So, for example, in this example, the second one I showed you, all we've done is put it at this low. We know that if price goes below this low, the chances are it's not reacting from that fair value gap and breakup structure, and chances are I've got my analysis wrong, or I've done my analysis right and market just hasn't went in that direction. That happens, that's natural almost. You want to give price enough room so that it can visit any sort of liquidity. So there was a fair value gap here. We know that price may want to revisit that zone. It has, and that's why we didn't get stopped out on this occasion. Moreover, another thing that's really important is your risk to reward. As we can see on TradingView, it says a 3.15 RR for this one. That is brilliant. For you to be a profitable trader, you can have a 1-to-1 risk to reward ratio on every single one of your trades, and you only need to win 51%. If you have a 2-to-1 risk to reward ratio, it means that you only need to have a 34% win rate. You don't have to be able to win loads and loads of trades. All you have to do is basically use a decent risk to reward ratio. My advice would be try to never ever have a negative. When we say negative, all we mean is a less than 1. So your stop loss is larger than your take profit. I also mentioned about putting your stop loss to break even. This is really important. So if we go back to this example, and I had my TP at this order block up here instead of the first fair value gap. Price would have went up nearly 200 pips and then came back and hit our break even point. That is not a problem. I'm not upset by that. What I would have most likely done is put our stop loss into profit. So I might have put our stop loss 50 pips into profit so that we just get a win, albeit not as much for winners as we would like, still a win. Now in this example, price did end coming back up, but like I say, hindsight's the most difficult thing in trading, because you'd always think, oh well, I should have done this, I should have done that, I should have done whatever. You're trying to minimise loss, you're trying to minimise risk. Always put your stop loss to break even when you go into significant profit. So I hope this video has given you some degree of insight as to what exactly I'm thinking about as I'm trading. You need to go and sit down in front of your laptop or your computer, open up TradingView and be able to actually analyse the market, think what I'm thinking, and then place the trades that I would potentially place. I'm going to join the group. We have free signals, we'll have education, we'll have a community where everyone's becoming profitable together. Get out my bio, I'll have a link to the Telegram, join that, drop me a message and we'll get you involved. Peace.